Buyers and sellers often worry about goodwill. You'll regularly see a large component in a sale price and it's called goodwill. Now, goodwill means different things to both buyers and sellers, and they both have their own concerns. So let's have a look, shall we? What does goodwill mean to both buyers and sellers? To sell a business, a seller needs to confront the need to provide confidential information to potential buyers. Now, potential buyers could be competitors or opportunists looking to get some advantage from the information. Since competitors are often the most suited buyer and an opportunist is difficult to distinguish from a genuine buyer, it pays to proceed with care. A standard precaution is to ask interested parties to sign a confidentiality agreement, also called a non-disclosure agreement, before providing that party with any commercially sensitive information. A business broker or your lawyer will usually assist with this aspect. The terms of a confidentiality agreement are typically not contentious, so they're unlikely to deter any genuine buyers. I talk about confidentiality and disclosure in business sales up here. Have a look at those. Another precaution is to disclose confidential information in stages. The levels of information provided could vary depending on the type of business and the number of interested parties. The first stage could involve providing basic details such as turnover, gross profit, information together with details of the lease of the premises, etc. The first level of information should enable the buyer to make a conditional offer. The terms of that offer would then determine whether it was worth proceeding to the next round of disclosure with that party. Now, this process should reduce the number of people that see the most sensitive information of the business to only those who have a realistic prospect of making the purchase. They've made a conditional offer and lodged a deposit into the broker's trust account. Managing this process is essential in ensuring the sale happens, but without damage to the business, something a skilled business broker should be very, very good at. The amount of goodwill as a percentage of the total price varies, but it is commonly a significant component. For that reason, buyers are often sensitive to the need to ensure that the goodwill is transferred to them on settlement. Goodwill can be contained in a number of areas of the business, including the location of the business, brand name, telephone numbers, email addresses, websites, key employees, business contracts, and business records. Now, a standard sale and purchase agreement will often deal with most of these items perfectly adequately, but it's certainly worth reviewing the business during due diligence with the focus on where the goodwill is concentrated in the particular business that you're looking at. To find out if the business, and consequently the goodwill of the business, is too reliant on the owner's performance, have a look at this video up here. That should help. In carrying out due diligence on a business, buyers should identify whether there are written contracts and whether those contracts are capable of being assigned. There may be a case for inserting additional clauses to cover any issues with the assignment of contracts and include formalizing the old owner's obligations to help make this happen. Now, contracts can often be relationship-based and sometimes very hard won. So it's important that the owners of the business agree to, one, a restraint of trade clause, and two, how they're going to transfer those contracts. In a general rule, the enforceability of a restraint of trade depends on the scope and scale, the price paid, and the amount of goodwill. Sometimes goodwill is calculated with a reference to turnover. A buyer will have expectations that turnover will be at existing levels or better going forward. Now, the seller typically warrants historical figures are accurate but makes no representation or warranty about future turnover. That can make a buyer understandably nervous, and from time to time buyers will negotiate what's known as an earn-out provision to mitigate the risks of turnover failing. Now, an earn-out provision structures the deal so the seller only gets more than the buyer's offer if the business achieves turnover targets post-settlement. Now, whichever route you take, preserving the goodwill and enabling the transfer of that goodwill to a new owner should always be an important consideration in any business sale. Thanks again for watching. If you want to know more about business sales, maybe you want tips on improving your business, start right now, hit that subscribe button. If you like the video, please leave me a thumbs up, maybe a comment down below. I read and reply to every comment and I would love to hear from you. Until next time, see you then.